Heading to the closing bell, and his Spinal Tap would say these markets go to 11 and much higher today. Let's talk about this with Sam Stovall, Chief Investment Strategist at CFRA, and Jeff Yastine, WealthPress Senior Investment Strategist, all joining us right now for the closing bell. Let me start with you, Jeff. You're telling people to buy oil. Why?
I feel like it's still a very under-owned asset. It's gone through this huge down cycle. It wasn't, 10 months ago or so that we had negative oil prices for at least a very short time. And as a consequence of all these things going on, it's pushed so much of the supply side basically into bankruptcy on the shale oil producers and those types. And as we move out of the pandemic, and we will move out of it, as time goes on here, it just means that oil demand is going to increase, and there's going to be, something of a bottleneck. And I think that's why we continue to see oil prices move, higher and higher here, despite the fact that the economy continues to sort of lurch along in low gear with lots of stimulus.
And Jeff and Sam, stand by. We want to bring in Jared Blickery quickly. That's hard to say back to back as we head into
my mother's good at it.
And Jared, there's a lots of buying action here today. We've been talking about it for much of the trading day. All 11 of the S&P sectors are in the green. What stands out to you?
Well, I'm looking at Alphabet up to a record high of 2%, and this comes right before its earnings. We're going to get those in just a couple minutes right after the closing bell. So we'll keep an eye on Amazon as well. Amazon's up 1.3%, not at record highs, but could be the breakout if we get a reaction in the right direction. But just remember what happened to Tesla and Apple in weeks prior. The reactions this earnings season, despite the high beats, have not been positive. Well, here's today's sector action. And yes, we will get to those Reddit screens in a second. Financials and industrials, discretionary and communication services, all outperforming up 2 or 1% respectively. And then healthcare and real estate to the downside. Now, also in the travel space today, getting a really nice boost on the reopening and vaccine news. We're seeing Booking up over 3%, Royal Caribbean up 4%. Even the gambling space on that reopening trade looking good today. DraftKings up 8%, Penn National up 6%. But guess what? Movie theaters aren't doing so well. We got AMC down big. Of course, that is a not Yahoo Finance. It is a Wall Street Bets Reddit trade here. AMC down 41%. And here is that closing bell.
And that does it for us today. All three of the major averages in the green, although well off the highs of the day. You're seeing the Dow close up just around 476 points, S&P up just around 1.4%, Nasdaq up 1.5%. All 11 of the S&P sectors are in the green. And some of the standouts here in today's action within the Dow, Goldman Sachs, the top performer, up just around 4.5%, Caterpillar and Dow Inc. rounding out the top three. We want to bring back in our guests. We have Jeff Yastine. We also have Sam Stovall standing by. Sam, let me just go to you first. Just the buying action that we're seeing today, 2 days in a row now. What do you make of it, and where do you think we're headed this week?
Well, I think that people are basically breathing a sigh of relief that we are not going to be in the midst of a long-term capital management style of liquidity crunch, which drove us down almost 20% back in August of 1998. So I think that investors are saying, now let's go back, focus on the fundamentals, focus on the earnings that Jared just mentioned. Let's go and realize that expected to be off 12.6% in the fourth quarter, now only 5.6% lower, and with each of the quarters seeing upward revisions for 2021.
Jeff, Sam just brought up long-term capital management. Back then, the banks had to bail out the system, not the taxpayer. Fast forward now, we got this thing going on with GameStop and Reddit. I'm curious, you call this a canary in the coal mine. Why?
Well, it mainly goes to the whole thing of how much, let's say, a lack of concern, a lack of worry, sort of a tossing away of fear in the stock market. And, I'm speaking sort of broad ideas here, but, that's how the stock market moves, generally speaking, is in broad sweeps. And one thing that keeps the rallies healthy is when you have a degree of fear in the market. And so when you look at sort of how the activity has moved to this point with Wall Street Bets, and, we can sort of cheer on what happened to short sellers and all that, but at the same time, it shows that there's just a lack of concern, a lack of fear that investors of all kinds can essentially move with impunity. And just, my instinct at times like that is to draw back a bit and say, maybe you shouldn't get so comfortable, because, that's what happens at the end. And I'm not saying we're at the end here, but I'm just saying this is a time to be very careful, because when you're coming up on the end of these things, that's typically when people lose most of their fear. And, you take all your chips and you're pushing them into ever bigger piles for the stocks that you're going after, and it works until it doesn't work. And then you really get a lot of pain.
Sam, how are you looking at the speculative frenzy that we've seen play out over the last week and a half? Is this something that causes you to change your strategy or your outlook at all?
No, it doesn't cause me to change the strategy. Our year-end target is still 4080 on the S&P 500, which is a high single-digit price appreciation. But like Jeff, I'm a bit concerned that we are due for some sort of digestion of gains. When you have two nieces who have never invested before give you a call and say, I want to get in on the action, you can't help but think of Joe Kennedy and Bernard Baruch getting advice from their shoeshine person. Also, seeing advertisements on television for all of these trading systems that one can put on their phones and just start trading away really without looking at the fundamentals. Yes, that is a bit of a concern right now, but I think it's more of bubbles, pockets of bubbles, not the entire market itself being in a bubble.
Jeff, we're going to be getting Google and Amazon earnings any minute now, but I'm curious, you're telling people, big tech, yeah, stay there, but beware some of the stay-at-home plays that they're exhausted. Tell us more about that.
And mainly the idea is there is that, number one, the reason to own them is going to go away as we move through the back end of the pandemic. And secondly, I think that just in terms of valuations, they're just very, very stretched. And I think they're beginning to show that. And I think like these last moves we've seen over the last, 6-8 weeks or so with like, Peloton and Chewy and some of those, they have that look of exhaustion about them, considering the stretch valuations that they have. And really for a lot of the rest of the FANG stocks, with the exception of Google, and let's say Tesla, if we want to throw them in there as well, most of them have been moving sideways since like July of last year. And they don't appear to be able to sustain in advance. Now, maybe the earnings come out, and I could be completely wrong on this. But when these stocks go through this long sort of consolidation period, obviously at the far end of the consolidation, it's going to break up or it's going to break down.
All right, guys, hold on one sec. We have some breaking news. We want to get to Jared Blickery for Amazon earnings. Jared?
Don't say that twice. We got a new CEO at Amazon. The transition is about to begin. Jeff Bezos is going to become executive chair, and Amazon's own Andy Jassy is going to become the next CEO. That is the big news right here. And just checking on the stock price, you can see it is up 2.3%. So the market taking this transition of power pretty well right now. And by the way, the numbers are very good for the fourth quarter. Let's go over those now. We have net sales of $125.5 billion. That is up 44% year over year, and handily beating the estimates of $119.7 billion. Amazon Web Services, those revenues came in at $12.74 billion, and that is just slightly behind or roughly in line with the estimate of $12.77 billion. That is an increase of nearly 10% year over year. And then EPS came in at $14.09 per share. That is a jump from $6.47 1 year ago, and very much higher, actually almost double the estimate, which was $7.34. Operating income coming in very much over expectations, $6.87 billion. Estimate was for $4.5 billion. And fulfillment expenses, those were $18.5 billion, coming in roughly in line with the estimate there. So big news, Jeff Bezos transitioning to executive chair, Andy Jassy becoming the next CEO, and just beating on a lot of records. Oh, I do want to point out, we do have a first quarter forecast here I want to go through. They are seeing net sales of $100 to $106 billion. The estimate was for $95.7 billion. So another nice beat there on a key metric. Guys?
We have another nice beat, too, a multi-billion-dollar beat for Alphabet, Google, and S4A is going to bring us up to speed on their earnings. Inez?
Yeah, that's right. Alphabet's fourth quarter revenue ex-TAC, that's excluding traffic acquisition costs, came in at $46.43 billion. The street was expecting $44.16 billion. Taking a look at the company's fourth quarter earnings per share, $22.30. The estimates were for $15.58. And also looking at Google Cloud revenue, that came in at $3.83 billion. The street had been expecting $3.8 billion. Alphabet's CFO saying our fourth quarter performance with revenues of $56.9 billion, driven by search and YouTube as consumer and business activity recovered from earlier in this year. Very important that this year also, this quarter, it was the first time the company was breaking out its cloud unit, broken out as a separate segment. So you've got now Google Services, that includes the search, ads, Chrome, YouTube, and then Google Cloud. And that cloud revenue beat expectations. And then other bets, and those are the moonshot sort of projects, including Waymo. And analysts had really been expecting that the sum of the parts would be very valuable when valuing the company, so to speak, valuable information.
We want to bring back in our guests, Jeff and Sam. And Sam, let me just go to you first on that news that we got out of Amazon, not specifically talking about the company, because I know you can't talk individual stocks, but when you see a move like this, a name like Jeff Bezos making the transition from CEO to executive chairman, I'm curious just as an investor, how you're viewing this and what this potentially means for a big name like Amazon here going forward.
Well, Jeff Bezos is Amazon. So, the first question one asks is, where will he be in all of this shakeup? But with his being still as an executive in control, maybe not to day-to-day operations, but in terms of overall strategy, I would tend to say that investors will breathe a sigh of relief that his influence will still be very much felt by the company.
Jeff, I want to keep talking about Amazon here because that revenue beat was really spectacular, 125 billion, I think it was. But first quarter, it's above 100 billion is what they're forecasting. This would be one of those stocks when we were talking before the earnings, you were saying, be careful some of the stay at home, but Amazon, it's on fire.
It is. And again, that's why really, if you're going to make a case for, let's say being careful about buying the stock here, and even if it did fall, chances are it seems like it's everyone's safety stock. So really, you talking about a decline of what, 10, 15% probably at most. But still, it's really just a matter of how much of the growth that we're seeing is already baked into the price and already discounted into future expectations. And so, there's just no question the company will continue to outperform. It's a premium stock, and everybody knows it. So it's just a matter of how much is too much to own the shares, and at what point do people turn perhaps somewhat more pessimistic? Again, knowing that a lot of the valuation is already baked in, or a lot of the growth is already baked into the valuation.
Tim, at this point, we've gotten Amazon and Google today. We heard from Facebook last week. We heard from Apple. How are you looking at the tech sector right now? It was a leader last year. Many investors are still favoring it at this point. Are you finding reason to buy into some of these names now?
Well, on some of the names, absolutely. In terms of Apple, Google, Amazon, obviously Amazon is consumer discretionary. But in terms of technology expectations, we have a market weight on technology at this point. Our belief is that it'll probably keep pace with the market, but in the coming year will not be an outperformer. We look to earnings growth for next year, up 13.6% versus 21.3% for the overall market. But obviously, you can look below the surface at certain sub-industries and individual stocks that we think could do relatively well.
We have been paying attention to some big tech stocks, but wanted to let you know that in just a second, we're going to go to Jared Blickery on Chipotle, because Shauna, I think you'll recall it was about 5-6 years ago when they got into trouble. That stock lost a great deal of its value, and today it's trading at $1,525 a share. But in the post market, it is down almost about 1.6%. And I believe that Jared Blickery is standing by for us with the earnings, and he's going to break that down for us in just a second. But Jared, what have you got?
All right. Well, it was a miss on the bottom line. So adjusted EPS coming in at $3.48. Estimate was for higher at $3.72. 1 year ago, it was much lower, $2.86. But comp sales here also missing. That is a key metric. That was up 5.7%, but it did not match the estimates of a little bit higher at 5.9%. Revenue coming in just in line, $1.61 billion. That was exactly what the street was expecting, up 12% year over year. And new restaurants coming in at 61. The estimate was for 48, 49. So that metric in particular, a little bit higher than expected. And then finally, restaurant level operating margin. That was 19.5% versus estimates of 19.7%. So a bunch of misses around the board here. A couple of numbers like revenue in line. Just taking a look at the stock, we can see it's down about 2.3% there on your screen. And just looking at a longer term chart, I mean, you want to check out what they've done over the last month. This year, they're up 10%. Over the trailing year, they are still up over 75%. But we've seen a lot of these companies really take it on the chin, even when they beat earnings this earnings season. So we'll have to see what this kind of high-profile miss means for the company in tomorrow's trading when we open.
Jeff, thanks, Jared. Jeff, how would you look at a miss like this? Because like Jared was saying, if we do see a company, even if they meet expectations and don't far exceed them, we see investors tend to sell some of these names. So I'm curious just to get your reaction to the action that we are seeing in Chipotle here after hours.
Yeah, you can't take these things too far in the immediate, after hours, or the pre-open, tomorrow, because, it's just not a very liquid environment. So, who knows really what's going on there. But yes, in terms of companies getting sold after, hitting their targets, again, you can make an argument there that it's basically investors saying, yes, that's fine, but what have you done for me lately? And basically looking to, they bought the rumor and now they're going to sell the news. It's just not good enough because the price already reflects all of that good news that's already built in. So that would be, a warning sign regarding, again, what I was saying earlier, valuations getting stretched. And it just takes time for this sort of thing to play itself out and see whether or not it really is a true concern, or we could be talking about this next summer or this coming summer, and you might still have the same concerns. We've been talking about this stuff for years now, and we've yet to see any sort of real meaningful correction, and certainly no bear market. So.
Sam, I know you can't talk individual stock, but I'm looking at the prices of these stocks for which we're reporting earnings, anywhere from $1,500 to $3,300 a share. And you had mentioned your niece earlier. How does someone who I'm assuming is young and might be early into investing deal with pretty common stocks that are that expensive? What is the message that's going to be sent to the next generation of investors?
Well, interesting, but I remember when I was their age, her age, stocks typically split once they hit $80 to $100 a share because people didn't want to pay that much for a stock. They didn't want to invest that much capital in and only get one share out of it. So typically, you would have reverse splits below $20 and splits above $80, et cetera. So yeah, they end up really only buying one share or possibly buying fractional shares because that's the new thing that is available to them. But I think just being able to claim that they are owners of the companies that they deal with on a daily basis, that they subscribe to, that they use in their everyday activities is really what they're looking for.
Jeff, as we wrap up here, just your final thought on what you're going to be focusing on as we turn our attention to tomorrow's opening bell.
It's going to be more of the same as far as looking to see whether this advance can continue. And of course, I think everybody's looking at the progress of the latest stimulus proposal as it makes its way through Congress, and where that compromise is. I think that's the biggest thing, the closest thing on the stock market's plate right now.
All right. First, want to say thank you to both of our guests for being here today, Sam Stovall, as well as Jeff Yastine. Good to see both of you. And want to let everybody know that tomorrow at 9:20 a.m. on Yahoo Finance Live, Chipotle CFO Jack Harton is going to be on to talk about the earnings that we were just going through. And maybe one of the questions we can ask is, why not have a stock split at $1,525 in the post-market a share? That's tomorrow, 9:20 a.m., CFO from Chipotle.